We paid off all the debt, and it's just sitting in the trust, tax deferred. Yeah. Okay. So now the funds are sitting in the trust. Okay. Where are the funds settled? That's the next question you want to ask. How do I know my funds are protected? They're sitting at some of the largest banks in the world: TD Ameritrade, Charles Schwab, Bank of New York Mellon. You can have your own financial advisor manage the money. We have thousands of financial advisors across the U.S. who you can hire them across just about every state in the U.S. Okay. But the point is, the funds only ever move with your signature. So my role in this, Seth, is a trustee. So in order for this transaction to work, we must have a third party, unrelated trustee. Okay, so it can't be your brother, sister, cousin, and they're in it for business purpose, which I am. We can make a fee, which we do, and we serve as kind of like a custodian, kind of like a Seth Ira, if you will, right? Yeah. Whereas once the funds are there, as long as they're in investments, properties, in stocks and bonds and mutual funds, you're fine. And that's the other thing that's a real advantage. You don't have to be in real estate within 180 days, because remember, our parents taught us to sell high and buy low. But the 1031 exchange is not friendly to that, because we typically sell high and 180 days later we end up buying higher, especially in a seller's market, which most I think would agree we're in a seller's market. Yeah. And the other thing that also happens is what's called the interest rates. They start to go up. Okay, they could go up, right? So not only are you buying at a lower cap rate, which means a higher price and a lower return, but you're also getting caught on the other side, which is the interest rates are going higher. So you're like, do I really want to overpay? The other thing is you're taking on all that debt. So remember, in our scenario, we paid off all the debt, and it's just sitting in the trust, tax deferred, and stocks, bonds, and mutual funds of your choosing based upon your risk tolerance. And then let's say tomorrow you find a deal, or day 181, or even 3 years from now, right? And you're sitting in conservative bonds if you want to, very, very stuff that's not risky for the stock market per se, right? Then you can redeploy that money, right? So that's the Monday morning quarterback. Imagine it was 08 all over again, or 07, 06, before the crash happened. Knowing what you know now, what would you have done? You would have sold at the peak. You probably still would have paid your taxes if you didn't have a deferred sales trust and just waited, because you knew this thing was going to shift by 20, 30, 50% in some markets. But instead, you have the deferred sales trust where you're sitting and you didn't pay that tax, and your cash is kind of just waiting. You're debt-free, and then all of a sudden you can purchase property, which is actually what happened. One of our clients did that. He sold basically in 06, waited 5 years, okay? And his property that he sold was foreclosed on. And then those 5 years later, through his deferred sales trust, he bought the property at 60 cents on the dollar, all tax deferred.
Yeah.
Oh, by the way, with the new depreciation schedule.